Prospector News is media for educational purposes only and should not be construed as advice. We are not a certified financial analyst, licensed broker, or fund dealer, exempt market dealer, or hold a license to provide financial advice. We provide no legal opinion regarding accounting, tax, or law issues. Nothing in this podcast should be construed as investment advice or the solicitation to buy or sell stocks or commodities. All opinions expressed are those of the participants and should not be relied upon when making investment decisions. Those decisions should be made with the advice of a personal financial advisor. If you have enjoyed our podcast, please hit the like and share buttons and be sure to hit subscribe. I'm Michael Fox, and this is the Prospector News Podcast. Joining me, we have longtime friend and associate Chris Temple of the National Investor. Hi, Chris. How are you doing today?
Well, fortunately, staying cool. I'm out here in the desert in Las Vegas at Mark Skouson's great Freedom Fest conference, and fortunately, they have air conditioning at the Mirage because it's been 110 or so out every day here.
Yeah, I guess that makes my 80 and 90 here in Prince Edward Island seem rather tame in comparison.
Right.
But as they say in Nevada, at least it's dry heat, right?
Well, they can take their dry heat and keep it. I wouldn't even be here if it wasn't that this is where the conference was. But anyway, it'll be for a few more days.
No worries there. We're going to talk today about the Fed and what they're going to do and inflation. We've had the inflation numbers come out this week. CPI was 9.1% and the PPI was 11.3%. I'm not going to say they're historic highs, but they're a lot higher than we're used to.
Well, they are. And I mean, the CPI number especially, that's another fresh 41, I think, year high, highest since 1980 or 81. And it's not any surprise. I mean, when you're the Federal Reserve and for 2 years you're printing money like a drunken sailor to keep the markets propped up and asset bubbles inflated and allegedly save us from the self-imposed recession that other policymakers put us through thanks to the COVID pandemic. And it is part of that when you've created 30% of the dollars that have ever been created in the history of the US, all in about 2 years, this is what's going to bleed through. And eventually you're going to have this kind of inflation, and it's not going to go away anytime soon. Now, unlike what some people thought and hoped, Mike, back in March, when we were getting above 8% on the headline year-over-year number, and they thought that might be the high water mark. This current one probably is, but that does not mean we're going to go down to 2% anytime soon, barring the Fed engineering a depression, which they seem hell-bent to do lately. We're gonna plateau off it. Maybe we'll see inflation come down to 5%, give or take a little bit, in a best-case scenario. But we're going to have much higher inflation going forward as far as the eye can see.
Yeah, I don't disagree. I would agree in the short term, we may see a few months where the principal rate itself is lower, but I think as we get back into winter here and in Europe, and those energy prices start to spike up seasonally again, I don't think that these highs are the highs that we're going to see yet.
Maybe not, and you could be right if we had an extreme energy situation. I recently, as I'm sure you saw, as natural gas and its correction came down to its 200-day moving average and stopped dead on that and has started to rebound. I'm more bullish natural gas right now than anything. And so I made recommendations to my members that we take fairly aggressive positions in natural gas, not the natural gas related stocks, but the ETFs, both the regular and the leveraged ones on the natural gas itself, because I think that before too many months, maybe even weeks go by, we're going to see the North American Henry Hub price for natural gas will be in double digits. We'll exceed the highs of a few months ago, and there's a number of reasons for that. So, and if that turns out to be correct, let alone we get a more acute spike in natural gas because of at least in part what's going on overseas, then yeah, when that goes through into real world inflation and people are paying double and triple what they were last winter to heat their home, then yeah, we may not have seen the high number. You could be right.
Now, energy prices, that's a factor of government policy rather than Fed policy. What is it going to take? Are we going to actually have to have people freezing to death in their houses for the government to pivot on their energy policy?
Well, we'll see. I mean, it's both Fed policy and government policy. Real quick history lesson. When you go back to the 1970s, Mike, and we had an Arab oil embargo. Oil at that time went up to, what was an unprecedented high of $40 a barrel. We had double-digit inflation. It was made far worse by Arthur Burns, who was Fed chairman back then for Nixon, accommodating those price increases. Because when you go back there to the cause of that initial oil shock, we weren't going to get the oil from Arab nations, no matter what interest rates were, no matter what the value of the dollar was. But in the name of supposedly cushioning the US economy from the oil shock by cheapening the dollar more, Burns actually exacerbated oil prices and made them worse, because by his monetary policy, keeping the dollar down, keeping interest rates low as inflation was bubbling up, he accommodated a higher price. And so Jerome Powell did the same thing in spades this last time, where in the name of cushioning the US economy from the self-imposed recession early in 2020, he made oil go higher than it would have otherwise, because he so cheapened the dollar and kept interest rates too low for too long and printed too much money. We weren't going to get these supply chains unstuck by what he did, because you're right, as far as energy itself is concerned, that is more so normally a function of government policy, but he made things worse. And so, he's trying to undo his part of it. The Biden administration has still made just a mess of our energy policy, whether you're looking at green energy or conventional energy. So the new energy that has already started is going to get far worse before it gets better. And there needs to be an awful lot done. On my website, as well as my YouTube channel, there's a lot of stuff I've said and spoken about recently on those subjects for people that want to check it out further.
Yeah, well, I tell you, it's not much better up here in Canada. We've had our Liberal government. The finance minister, Christina Freeland, was on the record last week as saying, "Hey, look, isn't this really great? We have high energy prices. It'll get people to stop using fossil fuels quicker."
Well, and that really, at least she was honest. Whether that was a matter of fact statement or a Freudian slip in a weak moment, I don't know. You would know that better than me. But look, down here, the same situation, Mike. Joe Biden ran for president promising that he was going to end new development and production of fossil fuels. His Treasury Secretary, Janet Yellen, who got that job in the first place because of her intent to use the office of the Treasury Secretary to beat the fossil fuel industry into extinction. And people they want us to forget about this now. They want voters in November down here, the midterm elections, to forget that. But that's what these people were out front and center with, was that they were going to do away with this. What they didn't tell us was that they were going to do this while doing little of productive substance to give us the replacement. So, we're left with the situation where policymakers are going to trash our energy economy and a broader economy with it. And then after the fact, it's going to take years to build or rebuild things. So this has been poor planning across the board, and really horrid policy by the people in charge right now. And it's, at least in Canada, I think in some respects you can say it's less bad, but that still probably doesn't make you feel all that good.
No, it's, what's Rick Rule always says, the prettiest horse in the slaughterhouse.
Yeah, pretty much.
Yeah, it's crazy. I just shake my head and it's like, people still have to get around. They still have to get their groceries. The groceries have to get to market. Energy literally fuels every part of the economy. And if you have a policy that's going to keep energy prices inflated, you're going to have the inflation problem that we're seeing.
Yep, that's right. So look, and even going beyond that, for people who have followed the massive corrections, whether it's in copper, whether it's in nickel and lithium, less so, I think they're less bad than some others. But all of these things first went to ridiculous high levels, and now they've all blown off as people have run for the hills thanks to the Fed tightening and a strong dollar and so forth. And what you've got to keep in mind, and I alluded to this earlier today when I did a virtual presentation for the Money Show's Accredited Investor Expo, is that now you've gone from bad to worse. And this is something people need to understand, that to hopefully vote all of these idiots out or replace them with adults who know how to build things. All right. Because the Fed has created a new problem now, or at best, they've exacerbated an existing one. And let me explain it this way. You say you want to build out an electric vehicle industry. So you've got a number of development stage and other exploration stage projects, let's say for lithium, just to use that as an example. If you're an investment bank or a development bank of some kind, or you're a major commodity producer now, and you're looking to obtain project financing for XYZ project, is your job easier or harder now with this yo-yoing of prices? It's harder. Copper went from a peak of nearly $5 to now, as you and I are talking, it's getting down closer to $3 a pound. It's not going to stay there forever. It could go lower if the Fed, doesn't take its foot off the brake pedal at least a little bit here sooner rather than later. But that just, when you need so much copper and so much lithium to build out the green economy of the future, you just put off most investment banks and most large pools of money and most major mining companies who might have been inclined to finance these things. Because as a lot of our listeners know, who have followed extractive industries and resource companies for a long time, you want at least some kind of certainty going forward that it's going to be good. There's all kinds of hoops that a development project needs to jump through. One of them is, of course, economics. And, you've seen for a lot of projects, the feasibility studies that come out for them, the costs have gone up considerably because of it in labor and material costs and energy and things like that. But now you've added another wrinkle in that the price of a lot of these underlying commodities now has been hit pretty hard recently. So we already had a situation where there's so little development in recent years and so much underinvestment in a lot of these industries that we need for the future. And now the Fed policy, from going from one extreme to the other, has made that job far harder for a lot of these companies to get financing. So, that's the consequence of having a fractional reserve system that is overextended, and some will argue at or near its end game. Is that the problem that we now have, Mike, is that not that we don't have a burgeoning need for a lot of these resources to be development to take us into the future, but that the money and credit structure to fuel that is badly broken and it's been horribly mismanaged.
Yeah, no argument from me. I work with a group called Orin Inc. They track all the private placements that go
Right.
into this junior mining sector, and literally for the last 10 years, we haven't been on the positive side of that index. So it's always been a challenge to finance these projects, and people don't realize that you can't just flip a switch and all of a sudden the mine's functioning and you're drawing ore out that people need today. It's a long runway, anywhere from 10 to 20 years from, drilling that first hole to actually having a mine if it's feasible.
Yeah. Well, this is a mess, and eventually the ingredients, I believe, will be in place, either the easy way or the hard way, to where policymakers and banks in Canada and in the US, since we're dealing with our own backyard for present purposes, they'll have the ingredients in place where we will finally have what we need to build out this economy of the future, to be more sustainable, to emit less carbon and so forth. It's not going to happen next week or next year, 10 years from now. I think people need to get that through their heads, but I don't think it's understood nearly enough, and the people in charge have not been punished enough for making a bad situation far worse by whether it's their pie in the sky ideas of what they think is going to happen. And again, this is the price we pay as citizens for tolerating this, whether it's in Canada or the US. There's so many people down here in the US, Mike, that want to believe that Joe Biden knows what he's doing. He does not. He has utterly no idea what makes the real world work. For half a century, the guy has been a demagogue and a tool of the military industrial complex and the power structure behind the scenes. Never had an honest job in his life. Justin Castro, we can say the same thing about him up there. And we're already paying a price for that. That price is going to get far steeper, I'm afraid.
Yeah, hey, no argument from me. I say this on both sides of the aisle down there and all throughout our parliament. We as citizens have got to stop electing idiots and morons to government. The cost of their stupidity is far too high.
Mm-hmm.
But
and again, that cost is going to continue to go up, regrettably.
Yeah, well, we'll add that to the cost of inflation we're talking about too, right?
Yep.
So the Canadian Central Bank this week just raised 100 basis points its prime rate. The Fed is meeting at the end of July. What do you think? Is 75 off the table and they're looking at 100?
I think that if the Fed at this stage were to go with 100, they would be shown to be too much in panic mode. There's already been a decline in commodity prices, which will benefit the numbers in future months sooner rather than later. I think that if they were to do 100, they would really undermine the markets. They would cause the dollar to go even more into orbit. And that's going to break something someplace else in the world, whether it's in Europe, whether it's in China, whether it's in some other emerging market or some counterparty. And already, because of the euro breaking parity, because of the horrid business environment, financial environment in Europe, there's already for many months already been stresses in derivatives markets in Europe and so forth. We're not far from an accident in the markets caused by the strong dollar. What I believe is going to happen is this: the Fed, because they've got everybody prepared for it, will stick with a 75 basis point hike. They won't do 100 like the Bank of Canada just did. And further, and the timing for them kind of stinks from a public relations standpoint, because they've got to tell us on Wednesday, the 27th, what their rate verdict is and what they may or may not do going forward. It won't be until the next day, on Thursday, the 28th, that we find out whether the economy really is in a technical recession. That's when we get the second quarter GDP. And if the Atlanta Fed is to be believed, we will have, and already have had, a second straight quarter of contraction in nominal GDP. So the Fed is not going to want to go 100 basis points, and then the day later, it's already demonstrated we're in a recession, because then you'll really see the markets crash. You'll really see the yield curve invert more. You'll see the dollar go, really into the stratosphere. So no, don't stick with the 75 basis points. And I'll add this. You won't see Jerome Powell blink, but you're going to see his eye twitch just a little bit, because they will on Wednesday, the 27th, acknowledge that everything is on the table for September, which not only includes more rate hikes of a higher magnitude if they think necessary, but a softening of the recent pace if commodity prices that have corrected stay down for a while, that they don't want to overdo things. So, and that could, maybe in a bit of a counterintuitive way, set us up for at least an intermediate term bottom in these beatings that stocks and commodities have taken. So we could be 2 weeks from a tradable rally. We'll see.
I see. So you're of the opinion then it's eventually the Fed has to pivot from this policy. So you're of the opinion that if we show a technical recession on the 28th, that's going to be enough to cause a pivot from the Fed.
I don't think that in and of itself will, because they will continue to explain away a mild recession. And look, they've been very honest, much more so than Powell was so long, and telling us inflation transitory when it wasn't. They've been relatively more honest in the recent past and acknowledging, you know what, in order to bring inflation back down, yes, we probably will cause a recession. It's not out of the question. Yes, we will see unemployment go back up. Yes, we will. And we're trying to reduce demand. So none of those things should be a mystery to anybody who's paying any attention. The risk here, Mike, and this doesn't get enough talk, the risk that they're taking is not putting the US economy into even a deeper recession. And look, they will tolerate this until the markets become dysfunctional. We have so far had the NASDAQ drop by 30% or a little bit better, the S&P 500 by about 20%, but nowhere along the line has there been a noteworthy instance of somebody is illiquid. This has been, in fact, a very orderly bear market, which is why a lot of people think it's not over yet, because we haven't had that final capitulation. We haven't even had an intermediate term capitulation. So what they risk if they don't at least hold out the prospect that they're not going to overdo things, they'll sit back, they'll see if, these lower commodity prices, especially of the recent past, the lower valuations for stocks and a little bit starting for real estate, if that starts to crimp demand, and maybe we don't need to do 75 basis points after July. We'll see, because they've got to be careful that they don't break something. It's not going to be here. They're going to break something elsewhere, because if they stay hawkish and the dollar keeps going up, I guarantee you we don't get to the end of the year before something a whole lot bigger than Sri Lanka goes bust.
So your projection is the Fed policy pivot will occur when something breaks overseas rather than here.
That's if they get forced into it. If they are smart and stay in control of events, they will at their July 27th meeting at least suggest that everything is on the table, including lesser rate hikes after July, if they see the economy continue to soften. And don't forget that just a month or less than a month later, they have the Kansas City Fed hosted the late summer picnic and soiree out in Jackson, Wyoming, with all of the other central banks. And they're all going to be getting together and realizing that with the massive debt levels the world over, there's only so much that these people can do in the first place to tighten policy. I mean, the ECB technically hasn't even really started yet. And they're on the edge of the Eurozone imploding financially. We're relatively better off in the US and frankly also in Canada, I think. But the Eurozone never really did recover from 2008. And so they got to figure out how to find a way to act like they're fighting inflation, but still keep things levitated. And again, that when you have a fractional reserve system in the first place, that's a whole different discussion for another day. This is the end game. This is where you just can't stretch the rubber band anymore. And it either completely blows up, or you have people come along that say, hey, we need to abolish the Fed. We need to abolish these privately owned, usury-based fractional reserve systems and have a completely different banking system and monetary regimen that benefits people rather than capital. But we're not going to get to that without a crisis or a revolution.
No, I wouldn't disagree. So where's it going to break? Europe, Asia, or Africa?
Who knows now I mean, as far as major economies, Europe has been trying recently to supplant China as the biggest major threat of a whole trading bloc and developed economy and regimen that would go bust first. You flip a coin, whether it's Europe or China. But yeah, you've got a lot of emerging market nations that are having trouble. You've got unrest in a lot of different places. You've got lower commodity prices now. So those emerging market nations that depend on exports, they're getting a little bit less for them at the moment on a cash basis. And their external debts denominated in dollars, which were already unpayable, are now going to even being unserviceable. And you just have to wonder at what point that somebody big enough, whether it's a country, whether it's a big swath of dollar denominated debt, what gets defaulted on that causes other dominoes to start falling. When now you default to one creditor and then they default to somebody else and then some other counterparty is in trouble. This is what happens in a fractional reserve system where you've got leverage on top of leverage on top of leverage. A chain is only as strong as its weakest link. And
so basically 2008 on steroids.
Potentially, yes. And I mean, whether anybody likes to admit it or not, and notwithstanding some of the more recent just total nonsense I've seen out there from some of the usual suspects about Joe Biden's secret plan to do away with the dollar and replace it with this or that, just total BS. Don't walk away from people like that, folks. Run. Okay. But notwithstanding that, the Fed of all times to again forget that it is the de facto central bank of the world, this ain't a good time. Because if the US was operating only in isolation, yeah, the Fed could raise rates some more, crimp the economy, and we could stand it, bring down consumption and so forth. But when they run up the value of the US dollar, they're threatening a lot of other things in the world. And contrary to, again, what a lot of these carnival hucksters that are always out there with their sensational stories say, when you have a rebellion in other countries against the dollar, it's not because the dollar is too cheap and being inflated away. It's times like this when the dollar is too strong and it's choking everybody else. This will, now look, let's be fair, this will help accelerate, just like a lot of other things that the U.S. has done recently, where it concerns Ukraine and Biden's policies. This will eventually accelerate the move away from such heavy dependence on the dollar globally. It will have that consequence. But for right now, by far and away, the problem in the world is not that the dollar is weak, not that it's going to be replaced, all this kind of crap. It's because the Fed has made the dollar so strong relative to other currencies and trading blocks that it's going to break something.
Yeah, well, you know what? I've always seen, I agree with what you say about the carnival hucksters, portenting of doom. I'm reminded of a quote, and it's brilliant, but I can never remember who said it, but you never bet on the end of the world because you'll only be right once and you won't be able to collect from anybody.
That's right.
Well, we've got interesting times. We've got a Fed meeting and a GDP happening at the end of the month. I'd say let's wrap it up for today and pick ourselves up in the first part of August when we've got some fresh news on economic data and the Fed to discuss further.
We're going to know a lot more after 2 weeks from today. We're going to know a lot more.
Absolutely. If people want to get a hold of you, Chris, what's the best way to do so?
Simply go to nationalinvestor.com. There's a lot of recent stuff on my site on a lot of different investment themes, public policy themes, the global economy and whatnot. And on Twitter, which is where I'm starting to try and do most of my social media activity. The handle is @NatInvestor.
Wonderful. And we'll talk to you again in a couple of weeks and enjoy your summer.
And you too, Mike. Thanks.